Welcome everyone to the 20th of July, the evening session of a look at the global markets. As I mentioned, we're not here to forecast the markets. That's a folly. We're here to look at what is in the markets, and then from that we can develop a action or reaction to events as they come along. For those who don't know me, a little bit of my background. I hold the Australian Diploma in Technical Analysis, hold international certification with IFTA. I spent a number of years on the desk with Macquarie and RBS and Wilson, spent 17 years in the background trading, hold ADA 1 and 2 derivatives accreditation. I'm a member of the Australian Professional and Technical Analyst Association, and I am president of the Sydney Australian Technical Analyst Association. Of course, the disclaimer: the material contains information from external sources and intended for education and general information only, does not constitute financial advice, and does not take into account your investment objectives, financial situation or particular needs, saying that you must consult a licensed advisor before acting on any information you may see or hear. And yes, throw out the crystal ball. Trading and investing is a business. Don't treat it like a hobby. Hobbies cost money. Businesses make money. It's the very subtle difference between the two, but treat trading as a business. There were some comments in the press last week. It's comments around what's going on. It was a broad comment, and I thought summed it up fairly well. It said that money printing leading to zero and sometimes negative interest rate outcomes has allowed many in business to remain in business, leading to an oversupply of everything. Coupled with the fact that our shelves are filled with cheap goods, essentially the world ex-China has been manufactured out of business. It means that we have no, in the face of the manufacturing capabilities of the cheaper nations, we have no opportunity to manufacture ourselves. The world is dealing with that in itself. In the background, there is with the cheap money available around the world, it is allowing businesses to stay in business. You'll see that in the petrochemical industry, which is essentially the reasoning behind oil heading downhill to where it did. Said by a large European bank is that Europe's stricken banking sector needs a euro 150 billion bailout to stave off collapse. The chief economist for the bloc's biggest lender has warned, and that biggest lender is Deutsche Bank. Deutsche Bank is the largest single potential event in the world at the moment that could go wrong. In the background, Deutsche Bank has ties throughout the financial community right around the world, and from inside Deutsche Bank, David Landau believes the industry could be headed for a disaster unless urgent action is taken. Now, that's a banker talking about his own bank. Maybe he's talking his own book just for a handout as well. When we look at price movement or look at any type of movement, we want to understand trend. And as simple as it is, this little diagram here on the bottom left gives us a picture of trend. When something makes a low price and moves up into a high price, I'll get my little pen out, moves up into a high price just in here and pulls back in a retracement and forms a higher low than the previous low and then moves through the high price, you have a trend in place. This methodology operates in all time frames, from intraday time frames out to daily, weekly, monthly type time frames. This is the definition of trend. There is no other definition of price trend other than this model. Trend has nothing to do with moving averages. Trend has nothing to do with indicators. Any other esoteric methodology has nothing to do with trend. It is the willingness of someone to pay a higher price than was previously paid, and it unfolds into trend, into a price trend in this case. The same on the downside when things move down. The fact that the market makes a high, then makes at this stage a higher low, and then the market moves up and fails to take out that high and simply forms a lower high through here and rolls over and comes down and breaks that previous low is the first stage of a downtrend. It is the definition of a downtrend, when sellers are willing to accept a lower price than what was previously accepted some end period before that. This is the definition of trend on the downside. There is no other definition, no indicators, no esoteric methods. It is simply price. Is someone willing to pay a price higher than what was paid before, or is someone willing to accept a lower price than what was paid before? With this in mind, when we look at Deutsche Bank chart, this is a 10-year chart of Deutsche Bank. That same person inside Deutsche Bank said Europe is extremely sick and must start dealing with its problems extremely quickly, or else there may be an accident. I'm no doomsday prophet, but I'm a realist. I think he's more concerned about the latest movement down in the actual bank price. Something is being priced in here. We can see the GFC top up here on the left. It was almost $100, the bank price at the time. Normal GFC low in here, and has simply failed to move out of there, and over a long period of time has moved into this broad downtrend. If this was occurring in Australia, there would be alarm bells ringing here. If one of our major banks had simply moved down like this, there would be simply alarm bells ringing. Inside Italy, UniCredit is Italy's largest bank. It also displays the same type of price action, particularly in the last year and a half, down through here, trading at just around $2. Recovery could be derailed by Italy's teetering banks, which are sitting on a €350 billion of bad debt. Their share prices have been hammered in the week since the markets were shocked by the Brexit, and since Brexit the stock price has lost 30%, which is not that hard to do down here sub $5. This is the biggest issue in the world at the moment. The second biggest issue in the world at the moment, and it highlights my context in my opening statement, is that no one knows where the world is going at the moment, not even the IMF. By their own analysis, they've been wrong now 5 years in a row, and quite optimistic 5 years in a row. If you look at the forecast, 2011 was here, 2012 was here, 13 was here. The only thing they are doing in the background is revising their growth targets down each year, and the real growth, the actual global growth, is this black line here. It is trending down. It has made a lower high here than the previous high somewhere up in here, and has made a low in here, had a movement up, made a lower high, and since then has broken to a new low. This is trending down. There is no evidence in here to suggest anything else other than something a bit lower in the future. We have no evidence of anything else, and trading is around evidence of something. We look at Lloyd's. This is the New York Exchange listed Lloyd's price. It has been had a movement up here at this stage, had a movement up here. In part of the larger movement, it is clearly moving down here, has formed a pivot point at just above $2.40, and this, as I say, the New York listed price of Lloyd's, there's something being anticipated in here as well. Not a great look, and then Brexit, the Brexit vote was in here, and has started in the actual outside range in here, and then this pivot area down below. On home soil, Wesfarmers, you may remember prior to Brexit, Wesfarmers purchased a UK hardware chain. Now Wesfarmers is up against it in the grocery area in Australia anyway, with some quite stiff competition, as is Woolworths, and also dealing with a low coal price, because Wesfarmers are essentially coal miners as well. Wesfarmers has been trading sideways for a number of years between this between this $37-45 range. Now, on my notes here, you'll see there'll be a chart on the right-hand side, left-hand side I should say, and on the right-hand side a couple of notes here, and what I've nominated is what's called a breakup and a breakdown level. So on Wesfarmers, it would need to break over $44, break up over $44 up into this area to get any sort of bullishness in the price. The breakdown level is this $39 area down through here. So we have this upper level, lower level on the stock. It needs to break one way or the other to give us an indication of where this might be heading. But this purchase of the UK chain may also bring a little bit of pressure onto their bottom line. As everyone knows, the pound really got hammered on the Brexit vote. Interestingly enough, it was really heading downhill for a long period of time prior to that. There was a small uptrend in here and a small uptrend in here, and eventually capitulated and broke to new lows. Currently, this is a snapshot. This is a weekly chart. It is a snapshot of this week so far. We have the what's called the dead cat bounce just here, and so far this week we have an inside week. Consolidation around this area, to see this bullish again, to see this move up, this needs to consolidate a little bit further out and then start to break these highs. So the breakup level on the British pound is 1.3536, which is essentially the high in here, and the breakdown level of course is 128, which was the low on the capitulation move after Brexit. There is a support level in 1985. The closing support in 1985 was actually 105, and the closing price in the 2 weeks that formed around that the closing price is 1.14. If we get a break below 128, this is certainly on the cards, 1.14 in there. There is a long way to go yet on the Brexit outcome. I don't think it would appear that they haven't grappled with it themselves, what it actually means. They've lost their food standards, they've lost their manufacturing standards. They have to now go and renegotiate their trade deals. Australia will be the first one apparently to renegotiate that trade deal with the UK, and it has been already stated that their GDP will drop by 0.5%, as will Europe's as well. When you look around the world at the three major manufacturing areas at the moment, these numbers are drawn from a website called tradingeconomics.com. It is a vast website of all the detail you might need on any country in the world for just as basically economic indicators. A couple of interesting things stand out. The top one here, the United States. They have GDP growth of around 2.1% per year at the moment. Now 2.1%, a lot of people somehow think that this is outstanding and the US market, the US economy is on solid footing and those types of things. Around that, as everyone knows, they have an interest rate of around 0.5%, but they have an inflation rate of 1%. Which is kind of in the lower end of really where it should be. Jobless rate at 4.9, this is considered full employment. And over here on the right hand side, which seems to have escaped a lot of media attention lately because it doesn't alarm anybody, is that their debt to GDP is actually falling. Government debt to GDP was well over 104%. I think it was up around 110, 115 at one stage, and is currently falling back and basically improving. In the Euro area, again, they have GDP growth of 1.7%, under 2%. Again, inflation rate here is negligible, and their debt to GDP ratio is now around 90%, also falling. In China, their GDP, as everyone's aware because it gets sent to us every month, their current GDP is around 6.7%. It improved just on the last tick that came out a week or so ago. Their interest rates are around 4.35%. Again, their inflation rate here is quite low, and their debt to GDP around 43%. Not that neither good, neither bad, I guess. Behind the numbers, behind what actually drives, you and I drive economies at the end of the day, about our willingness to spend and our ability to pay it back. Inside the US at the moment, their household debt to GDP is running at around about 79 to 80%. In the Euro area, household debt to GDP is running around 60%. In China, the household debt to GDP is running around 40% and increasing. So they're not particularly outstanding figures, neither are the inflation rates and neither are the GDP rates. When you bring Australia in to this mix, we can see that the Australian GDP, as everyone knows, is around a bit over 3% at the moment. The RBA is reasonably okay with that. Our jobless rate kind of fits in with everyone else at 5.7%. It's a little bit lower, would be considered full employment. Our government debt to GDP at 36.8%. A lot of questions around why are we being challenged on our AAA rating is because you may remember this used to be 0. And then it's been slowly climbing, and it's now into 36%. And this is the reasoning behind the challenge to the AAA rating, is whether this number here gets out of control or is reined in by government budget. The alarming figure in Australia is this number here, that household debt to GDP is 124%. If we had any sort of interest rate rise in this country, if the RBA decided it was going to turn around interest rates on any form of growing inflation, this is going to really benefit a company like Credit Corp, who goes out there and collects bad debts. This, in my little world, maybe not yours, in my little world, this is alarming, this number here. And the only thing that's keeping this up is our GDP. Being fairly solid, and our employment rate also being reasonably solid in there. If our employment rate started to rise, this number here would get squeezed, or those involved in this number would get squeezed very, very quickly. The 101 of economics of supply suggests that lower prices, which is deflation, lower and lower prices, come from oversupply. The current policy being deployed to try and incite inflation is really only giving us a deflationary outcome. The current lowering of interest rates has only allowed poorly run businesses to stay in business. I commented earlier that particularly around the US oil industry this is so, and while the consumer continues to purchase goods, and this is the issue in Australia, a lot of equity in homes at the moment, and we're continuing to purchase on that increasing equity. The line in the sand globally at the moment is the difference between growth and deflation. We are getting dangerously close that global growth is slipping into inflation. We saw the IMF chart a bit earlier, where global GDP is heading downhill and no sign of a turnaround, and the line in the sand is simply 0, and below that is deflation. So the real driver is still GDP and inflation. This is what the world is looking for at the moment, is what the central banks are desperately trying to stir up. However, the charts don't lie at the moment, and this is the kind of the message in tonight's webinar. In the US GDP growth rate here has been sideways for 5 years, backwards and forwards around this 2%. There is no trend in here. It could break to the high side, it could break to the low side. It's worthwhile watching to see which way it breaks, but at the way the IMF is talking, it would suggest it's actually going to break to the downside. Their 10-year bond yield at the moment, broadly over there's a 10-year chart as well, heading downhill, currently about 1.36%. And heading a little lower, but you can see a series of lower highs and lower lows and about to break lower again. The EU GDP, again around this 2%, is heading sideways in here for the last 5 years. The European Stability Fund, the yield off that fund, as everyone knows, has hit zero and is now underwater at just above 0.5% in there. Some of the 50-year Swedish bonds were auctioned at negative interest rates just about 2 weeks ago. So this is the trend on this: lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, is trending down. The Australian GDP growth rate in here, this same again, essentially sideways through here, bouncing around a little higher number, bouncing around this 3%, been over 3%, under 3%, but essentially bouncing around the 3% level, essentially on the back of the resource area. So here our government bond yield over the last 6 to 7, 8 years is heading downhill, and recently 2 weeks ago was under 2%, came back very quickly, and I think this week again has traded back under 2% yield. Lower highs, lower lows, lower highs, lower lows, lower highs, and currently a lower low. A futures contract is a standardized forward contract which can be easily traded between parties other than the two initial parties to the contract. The parties initially agree to buy and sell an asset for a price agreed upon today, forward price, with delivery and payment occurring at a future point, the delivery date. Because it is a function of an underlying asset, a futures contract is a derivative product. Futures contracts are negotiated at a futures exchange, which act as a marketplace between the buyers and sellers. A buyer of a contract is said to be long the position, a long position holder, and the selling party is said to be the short position holder, as both parties risk their counterparty walking away if the price goes against them. The contract will involve both parties lodging a margin of the value of the contract with a mutually trusted third party, usually the broker. Let's take a look. The copper market at the moment, we can see this is a 5-year chart of copper. Sorry, I haven't got a date line on there. 5-year chart of copper. What's interesting, and the point I want to bring out with this, some analysis around what's really going on in the world at the moment, other than declining interest rates and declining or sideways GDP, the copper chart over a number of years has also been trending down in the larger price movements, has been trending down, except in the last 6 months. This has now basically forming a base across here. It had a very quick look under $2 and was quickly came out of there to form this range that is trading in between $2 and around $2.30. In there we can see that the underlying RSI is also moving up and is currently at 50 or over in there, and it's not too clear. I agree, down here is the interest in these levels has just gone through the roof. So the copper is being heavily traded down at these levels. And correct me if I'm wrong, I think in the latest Chinese GDP numbers, their copper imports rose 22% in the last year. So it's this type of pattern that we're starting to see in commodities prices can be a very solid base forming in the charts, and particularly when you get a rising RSI with it would suggest that there's strength coming in here. Strength in price. So in the copper price, the positive is a rising relative strength. The breakup level on this is $2.32. The breakdown level that would ring alarm bells is $2. Australian stocks involved with this, of course, are S32, OZL, Rio, BHP, and CSE. Nickel is the same picture. We can see in most charts, including the copper chart, there was a capitulation low in most commodities in late January, early February. The nickel price has been heading down for a number of years as well, and has started to form this very significant base over a long period of time, in over 6 months in this case, and has just recently broken above the resistance level of around $8,000. So the breakup level that we're looking for nickel to continue on is $10,000 a ton. The breakdown level for nickel, we're looking at $8,100, which is essentially in this area here. A break below this low just there is essentially the breakdown level on this. Australian stocks involved with this, of course, S32 Rio, Western Areas, POS and DRA. Anybody that's been watching Western Areas the last couple of weeks has been a huge run. Western Areas chart looks very similar to this when you open it out in a weekly time frame. It looks very similar with a nice wide base being set in there and currently a retest to the breakout. So nickel also, we would have to say, is forming some form of base in here and starting to look a little higher. Aluminium, very much the same. Aluminium again found the lows in October, November, late last year, and is starting to trend at the moment with higher highs and higher lows coming out of there. And it's not the fact that the trend is in place, which is nice, but it's the width of this area here that's starting to get interesting. And with everything in the world going wrong, Brexit and a couple of other things potentially, it's interesting that these commodities are moving higher. So the breakup level on aluminium at 1,680 and the breakdown level 1,520. Rio, S32 and AWC involved with that. Australia is the world's largest supplier of bauxite by a mile. We currently supply around 70% of the world's bauxite. Coal, this is the thermal coal price. I want to point out here the same thing. Found its lows early January, forming a longer base, forming a long base through here. I'm sure this is just a data error, I hope it is. Forming a long base through here and now starting to trend up. Now this is the thermal coal price. I got picked up on this the other day. What about the coking coal price, which is currently around $96 a ton, somewhere in there. But the point of this is that from the lows, this thermal coal price has risen by about 60%. From the low price down here to its current price has risen 60%, and the hard coking coal has done exactly the same. So the breakup level on the coal price is around $62. The breakdown level on the coal price, we would be looking at $53 for an alarm bell to ring. The stocks involved with this, of course, are Rio, BHP, Whitehaven Coal and Yancoal. Anybody that's been trading Whitehaven, as we have in the last couple of weeks, the Whitehaven chart looks almost like a gold chart. Been terrific. The real, just on a lighter note, the real guide to inflation here could easily be coffee. Again, the coffee price after a very long downtrend, if you get a much larger chart out of coffee, you'll find there's been a very long downtrend, and it is also has this very nice rounding base in here and starting to break to the high side. Last week Starbucks came out and suggested in the US stores customers will pay as much as 30 cents more for certain beverages as the price for raw coffee have climbed amid rising operating expenses. So coffee is moving up and really starting to move out here. So this, on a lighter note, could be easily the beginning of inflation is your morning cup of coffee. The breakup level on coffee at 150, the breakdown level 140. We wouldn't like to see this low in here broken at all. So the yeah, interesting times in this area. Someone also mentioned orange juice has started to break out into all-time highs as well. Okay, iron ore, this is our most talked about commodity in this country. No one around the world cares about it, but certainly here we do. It also formed its lows down here in late 2015, early 2016. Hasn't really got into a trend yet. There is a very significant support level here at $50. This could easily be a capitulation movement below there. Iron ore, I can show you an iron ore chart in just a moment, but the breakup level, we're looking for iron ore to continue. What would get significant in iron ore is a breakup level over $62. What would be alarming is a break below 53 into the $50 range again. Would be quite concerning. So the stocks involved, Rio, BHP, Fortescue and Atlas, of course, and a few other miners in there as well. On the Trading Economics website, they do a forecast. You can overlay a forecast onto a commodities price, and they do their own research based around analyst expectations and their take on supply and demand at the moment. Their forward look on iron ore is essentially higher. They have a level of $67 and $47. It's this little window in here is their kind of window. They believe iron ore will trade between these two ranges if there's any further volatility, and of course Rio, BHP, Atlas and Fortescue in there as well. So this is looking a little encouraging. These patterns take a long time to work themselves out. But it does look like the base is in, certainly for Australia going forward in the commodities market. All right, well, let's take a look at some charts. Bear with me while I just change screens. I just want to bring in I'm going to use a couple of different charting packages. This is, I've got two. This is a Thomson Reuters screen. This is the iron ore chart. This is the actual Chinese ore price here on the futures contract, currently trading at 55.65 in here, and has set, we believe, a higher low at this point around $45 recently back in May, June, and hopefully we'll move out over that $62 area that we need as a breakout, as a continuation of that. So clearly the long movement down is starting to be arrested here, and would be reasonably comfortable at this stage saying that the lows are in. And certainly a break below this low here would be alarming, as would be a break below the psychological level of $50. The reason for that is this area back in here. A lot of action around the $50 mark before it actually broke down and moved lower. So it's good to see it back over that particular level. Now the other one that I wanted to look at was the DAX. When if markets are a forward-thinking entity, which they are, markets have a wonderful ability to foresee or price in potential outcomes in the future, and that's the issue with the Deutsche Bank chart and the UniCredit chart as well, and of course in the gold chart that everyone thinks that gold's the answer to everything, so it's been priced into gold. But the weekly chart of the DAX here, this area here was the Brexit volatility in there. It is starting to recover out of that Brexit volatility, but the issue of course is it hasn't really broken out of this trend. It's got a higher low in the chart, which is good to see. Essentially the DAX has been trending down, lower highs and lower lows, and it currently has a higher low, so we've now got this consolidation going on, potential consolidation going on here. So a break of this 10,200, 10,300 area is required for the DAX to look anything bullish again. DAX being the largest component, largest market inside the European Union, it's one to watch very, very closely. So a level break over this 10,200, 300 level would be very nice. A break over this outside period which was formed during Brexit would be almost now mandatory to see a break over that. And again with the FTSE, What we're seeing here is again the FTSE is really powered on, and it's come out of this. FTSE has been in a downtrend prior to Brexit. Through here, lower highs and lower lows. It formed a lower high here back in April, May, and broke down into a low in the broader sense here in June, July, and has since traded out of this capitulation area down here. Large outside range as well, but trading up here around the 6,700. Can't get my head around why, but it is. It did break above this, so we're looking for this same type of breakout in the DAX as the FTSE has done here, and it's the fact that it breaks over these downtrend line, and breaks over previous highs, high levels, where buyers are willing to come in and bid it higher. You really can get quite strong bullish moves. So the FTSE is certainly starting to power out through there. If this continues on through here, easily a test of the high would be on the cards. Anything can happen between here and here, of course, but it is certainly heading in the right direction. Has a very large range here. 1, 2, 3, 4 weeks ago, has a very large range here, and as a message of higher prices to come. So the FTSE, very different picture from the DAX, of course, but telling its own story. Now this is the weekly chart that we're looking at. Now I'll just take this away for a moment and bring in my other one. Like this. Very good. Okay. As always, a lot of interest in the Dow. At the moment, a lot of people were adamant that our market and the Dow followed each other. Clearly it doesn't, because the Dow is breaking out into new highs here, into all-time highs, and our market languishes down where it is, below 5,500. So what we're seeing, what's interesting about the Dow chart here, and it's the same in the S&P. You notice that the S&P broke into a record territory before the Dow. The S&P is made up of a multitude, 500 if you like, small companies, smaller companies than the Dow 30. But this is a very, very large range here out of Brexit, out of the Brexit area. And we're seeing this trade on some fairly high closes in the week. Each weekly bar has a high close in here as it closes out. Reporting season is underway in the US at the moment. Initially it looks a bit mixed, but this does need to continue on through here, or we're going to see a retest of this breakout level. Now the breakout level here of 18,360 odd, somewhere in there, 18,360 odd. You'll also notice, and I'll open this, close this up a little bit. You'll also notice is the mid-range of the candle last week, the mid-range of the week. Now, my methodology holds very strong views around midpoints. If we saw any weakness in here, this would be the first go-to area, 8,360. A break below that would basically see anywhere down through here tested, with the next support level down here at 17,900. Now the RSI on the bottom here has not formed a new high. RSI is sitting here, this is an RSI 30, sitting here, just to smooth it out a little bit, but sitting here at around 60. The market's made a new high, but the RSI hasn't made a new high. A little bit of a concern. What I do like about the whole picture of this market, and I'll close this up, is this this base here. It's not a double bottom, almost is, because this one's a little higher in here, but there is a significant spike low here in August 2015, another spike low here in January of this year, and a spike low on the Brexit, and with 3 spike lows in here, and the market's moving higher. Overall it bodes well for the for future movement higher here. Now, as always, those that listen to the Monday morning webinar, I focus a lot of attention on the Dow Transports. This is the Dow Transports here. Let me squash this up a bit. We can see that clearly see that the highs in the transports haven't been taken out. The basis of Dow theory is that two averages must confirm each other. The transports don't necessarily need to take out the high, but they do need to trend in line with the Dow. The Dow is trending up as making new highs and higher lows and higher highs. The transports haven't done that as yet. Now the transports have made their low down here, which is nice, and had 3 strong weeks out of that low point, but it does need initially to break over this area here of 8,150 and start to trend out through here. 100 years of history tells us, 100 years of Dow theory tells us that unless the two averages confirm each other, one, we're going to have a mixed market. If the transports turn down, and it will essentially bring the Dow down with it. The two ultimately follow each other. One will catch up to the other. The Dow will come back to the transports will catch up to the Dow, hopefully. The methodology, the theory behind this, a lot of people suggest that the transports don't matter. I would argue that point as long as you like. The transports do matter. This is a sign of economic activity when things are transported from commodities to produce to the things you buy online to retail things that you shop for are all transported. And you think with online shopping these days, and you can buy anything anywhere in the world, you'd think that the transports would be busy. We saw earlier that the US GDP, European GDP, very, very low there, and this is really a reflection of this low GDP, is that the transports index itself is not terribly bullish, so the transports are lagging in here. Inside of that, when there is a flight to safety, as with the bond market, you also get a flight to safety in the utilities. In the US currently, the utilities index is out here by a mile. This was the old high through here. The utilities index broke out in March this year, had a bit of a consolidation, and has significantly broken higher with a small consolidation here on the right hand side for the last 3 weeks. So it's looking a little like there is still a flight to safety in the utilities themselves. There's no inflation, so certainly it's not out here because of margin spread, but rather than a flight to safety. We're seeing the same often in a lot of our utilities here in Australia. If you look at Duet and a few of the infrastructure, toll and people like that, the toll roads companies, they are really travelling well. Sydney Airport is almost a utility as well, with a monopoly out there at Sydney Airport and first dibs on Badgerys Creek out the west of Sydney. All right, I will leave that there. I will sum it up here. Let me go to this. I'll take any questions if there's any questions, and we'll get through those. And I'll sum this up with this was put out as a global forecast. You can't forecast the global outcomes. You can only look at what is. As traders and investors, you are responsible for your own outcome. That's what you choose to do. So take the information, do the work, do the observation, be responsible for your own outcomes at the end of the day. And but gather the information in. Hopefully I've given you some insight into some of the things to look for, certainly some of the things I look for around the place. I've got a question here on gold. Yes, let's take a look at gold. This is, just keep in mind, this is the thing that everyone thinks is the answer for everything. This is the gold chart. What was very exciting about the gold chart, of course, is the lows in here late last year, along with the rest of the commodity markets. Gold found a low in here late in 2015. What's a little concerning about the gold chart at the moment is the way that it has rallied. It made a high here in March 2016, made a low back here at the end of March, made a higher high in May 2016, so this is all good, and then pulled back and made a lower low below the previous low. Now we've got a widening volatility, widening movement of price in here. It's basically what's called, and the fifth movement up here, a much longer move than the move in here. It's not anything to do with Elliott wave per se, but there is a essentially it's called a 5-wave reversal pattern, and the highest probability is that we may even see this high here tested at $1,300 or anything lower than that. It's depending on how the markets go at the time, but you would think with all of the concern around the world, particularly what the people in Europe are talking about around Deutsche Bank, you think this would be heading higher. Gold posted a engulfing week last week and is starting to trade lower. It fell $10 on the European Open this afternoon. A break of this area just here at 1321 would be a little bearish in the short term for gold. But there is a structure, wave structure in here that is a little bearish. You've seen the gold stocks come off in Australia rather dramatically. The issue with gold stocks in Australia is they're sometimes based around Australian dollar gold, which is up around $1,800, but it also with the lower dollar falling will help improve that. Which is good. We saw a little bit of support for them today when the Australian dollar dropped around to around 75 cents. But on a US dollar based outcome here, this has an engulfing body set last week and is starting to follow through as of this week. All right, are there any other questions there? Thank you. Thank you, AB. With all the bad news, why are the markets, the ASX and the FTSE, still heading up? I truly believe that there's nothing else to do except buy yield. In every day in my morning note, if we take a look at two things. One is the XMJ, which is the materials index in Australia. It broke out of a long channel just last week, which is a good thing. It is starting to trend here on the right hand side. It has what is potentially an inverse head and shoulders pattern in the base here, and could easily continue to trade out through this way. So it's broken out of the channel. It's starting to look a little interesting in here from this. Also, this is the capitulation low in January. This is looking really interesting, and I think this is really a reflection of the commodity prices themselves and the fact that the companies have done so much cost cutting that their margin is now quite satisfactory. I think even Fortescue has their extraction price down around under $20 or under at the moment. So we're seeing that in the XMJ. I'll open this up again. The other one that we need to look at in this country is the XFJ, which is the financials index. Sorry, I've got little things over this all over the place. Is the financials index, and I'll open this out. I've been drawing all over this. A lot of work to do yet, but in May this year it made a new high just here. It pulled back, it made a higher low here at 55.40 and is currently moving out through here, has formed a pivot point over the past 3 weeks and is currently trading out and looks like it wants to take out these highs just here. So we have a turnaround in there. There is a little way to go yet on the APRA requirements for bank liquidity in the background. It's a number of years away yet essentially 2. But this is starting to look a little encouraging. There's still yield in the banks. I think this is what everyone's starting to get a little interested in. If we squash this up a bit, in the morning note, I've suggested that we might see the financials simply range trade, and that is basically stating that we would see the, in particular, the financials index basically range trade around this area. A break of this high here at 6,100 and I think 70 it is, 6,170 would prove that wrong, and would have to act on that if that occurred. But this is just my view that we may see the financials range trade because they have nowhere else to go, with a lot of questions around their growth and that type of thing at the moment. So the yield is still there, so it's still a reasonable thing to do. One more question about the Aussie dollar, and we'll go. All the talking from Glenn Stevens when he was governor couldn't get it under 65 cents. This quite interesting back here in the Australian dollar around April 2015. This support level was recently, should have been a resistance level through here, was broken and then simply reversed out of there very, very quickly. But it is, again, I think the same, my little view of the world that I'm happy to live with is that we'll see the Australian dollar essentially also range trade, which sets up an enormous amount of potential, even in the, as you know, in the daily movements. But this is a weekly chart of the Australian dollar. We have at this point a pivot point reversal in the weekly chart. If we drill down a little bit into this and look at this on a daily basis, very simple application. You have an outside range, an outside bar set 1, 2, 3 days ago. Looks to be 15, 18, Friday last week. Set an outside range on the bar. Those that listen to the Monday morning webinar will know that an outside range has a potential to set a high or a low in the market within 1 to 3 bars. This one set it on the bar to be true, and this one did here as well. So it's the daily chart has an outside range with a small range next to it and a breakdown through here. So clearly my view of this, and it's only my view, I would encourage you to get your own view, is that this is simply range trading in this area. Failure to close out over this high set back in the 24th of June is clearly an issue. So our the only hurdle in this country was really the election and whether there was going to be majority government formed. This is not pricing in any great economic boom just yet. So the resources are reacting to the commodity prices. The Australian dollar is essentially saying that 3% GDP growth is okay, and interest rates where they are okay as well. We can also see that the CCI here, is Commodity Channel Index, has actually dipped below the zero line as well. All right, I will leave it there. Let me go back to my slide here. Okay, so I need to say thank you everyone for coming out. It's fabulous that everyone has come out. There's some familiar names there. I've been through the name list. Thank you so much again for attending. On Monday mornings, if you go to the First Prudential Markets website, on the front page, the home page, you can register for the Monday webinar. It is free, it is no obligation. And you can also register for the morning note that comes out, which is essentially just a summary of the overnight markets as well. It comes out every morning around about 9 o'clock in the morning. But the Monday webinar, we start at 9:30 sharp. It goes for 29 minutes, finish before 10. And it's essentially looking at what happened last week and where some ideas and some interest in where we might sort of trade in the coming week, which, if you believe that, well, excuse me. So but it will give you some ideas. That's the intent of it, is to give you some ideas to work with so you can go away and try them out. Thank you everyone for coming out. FP Markets does have an offer. Let me go back. FP Markets does have an offer for those that aren't account holders and would like to be an account holder. We'd love to have you on board. You must use this little promo code down here. Must use this little promo code. If you fill out the online application, it will get you a discount on the brokerage on the way through, along the way. So that's open to you. I'm not here to sell that. The guys will follow you up on that. But thanks again, everyone, for coming out, and good trading over the next 6 months.